Hello everyone, this is Bella. Welcome to my new teaching video of price behavior series. Recently, I have been busy at home, so the update has been a little slow. So much for high tide reversals and end flag reversals. Most of the price movements in the market we've already studied, but you should find that it's very difficult to just learn how to trade in the market and make a steady profit because the 10 or so pullbacks that we've studied, the intervals, the inversion patterns are taken individually and each of them is an independent point, and if one pattern fails, the novice may not be able to make the right judgment and decision, but we need to connect these independent points, which means we need to be able to connect them in order to survive in the market. Later in the course we'll enter the trading idea trading system learning before the start of the course, or to emphasize again on the inversion of the form of notes. Have not seen friends, can pause to look at here, I will not repeat. High tide reversal and end flag pattern. These two reversal patterns are difficult to enter trading. I am more used to manage already in the position of the order. Why not to trade the form to learn? Because only when you master the logic and laws of various price movements can you be calm in the trading market and better manage your own mentality and order. And the two forms we talked about today are not good trading but very common in the market. Let's talk about a high tide reversal. A high tide reversal is a manifestation of extreme sentiment in the market, and let's look at the bullish trend in the chart, which is more typical in a commodity market like this, where you can clearly see that the market has been overbought, and overbought is when a bullish trend has been running for a long time without a significant pullback. So if you look at these two channels, the slope of the second channel line increases significantly, which indicates that the market is accelerating, and the magnitude of the increase in the slope indicates that the market is desperate to buy. What do you mean the market is extremely greedy? What that means is that participants on the floor are afraid that the market is not going to give a good correction price and are willing to buy at any market price, and what it does is it shows up as a continuous strong trend K line, and the trend K line is getting longer and longer like this and breaking out of short-term trend channels like this one and this one as well. We all know that if the trend moves too fast and too far, there will be a lot of gains in that period, and there will be a lot of contrarian players willing to get in. So rationally we don't want to chase this accelerated price action. But why do a lot of weak traders, retail participants, they like to buy in that situation? This is being controlled by extreme greed, and for the most part, the upswings are always accompanied by good news, and the upswings are always accompanied by bad news. So when they look at this K chart that's moving faster and faster, they see not risk, but the illusion of huge profits, and fear that if they don't get in now, they will miss out on a big run, so they buy without waiting for a correction. When such emotional traders dominate the market, the strong players, the rational traders, the institutional players know that most people have already bought and there is no new buying force, and the institutional players are not willing to continue to buy at this price, because they have already participated in the trend from a very low position. When this extreme mood occurs, they will start to take profits and even start to trade backhands. And for traders who have taken short orders during a buying surge, the mood is one of extreme panic and impatience to wait for a pullback. Instead, they will buy to market and stop losses. When the last week shorts are desperate and the number of new longs in the market has tapered off, the subsequent move is easy to understand. Like any other reversal pattern, it is likely to be a deep pullback or a prolonged sideways correction, or a trend reversal. Weak traders often act in the opposite direction of the institutional weak bulls who have been sitting on the sidelines while the market is rising quickly, can't resist jumping in. Weak short traders who have lost a lot of money can't stand to lose money to close out their orders. The unrealistic fear that the market will rise further forces participants to do the opposite. They will pull up in this kind of climax in the long side of the hand out of the single. Even some institutions will be in the super Chongyang line after the emergence of batch short. For example, this one. Of course this is an institutional practice, and I don't recommend that you do this kind of high tide reversal batching because it requires strict position management and order management, and it's very difficult for us ordinary traders to execute. Seeing this signal, we will close our positions in batches. This is also the only effect of the pattern of high tide reversal for me. Mr. FIL led someone to buy this variety at more than $20 before. At $170 or so, it's clear that you've cleared all of your positions, and that's what a strong trader does. He's following logic rather than emotion, and he does close his position at that level, and then the price eventually peaks at 40%, but we should be looking at how much money we make and put in our pockets, instead of spending every day looking at money you didn't earn. I remember when it was above $200 or so, and that's when the market sentiment was at its most frenzied, and there were a lot of exchange groups or communities that were buying and selling, and of course it was not surprising that these people got caught. Why does a high tide reversal come so quickly and so completely? Take this bull trend as an example. Some strong momentum traders do add to their positions as the rally accelerates, because they also believe that the market as a whole will continue to rise, but at some point they decide that the market has gone too far, too fast. There's only a very short window of time in which they can sell their positions at a huge profit, and if they don't, then what starts as a small pullback in the market can turn into a complete reversal, and they lose the opportunity to get out at a good price. For example, in this FIL, and I think at the time it was at the $200 level, it was only going to stop for a couple of hours, which means if you didn't sell your order within a couple of hours, you would lose a huge profit or even a loss. While these major bulls are taking profits like crazy, the big institutional short sellers are picking up on this overshoot. You're shorting like crazy, and that's going to send the market down a couple of moves very quickly, and that's a big high tide reversal. A high tide reversal of the short trend, and you just reverse what we said above. And while it's easy to get a big, sharp reversal, it's like any other reversal that most attempts to reverse a trend will fail. A bull trend fever reverses and the price drops sharply, but when it falls to the level accepted by the main bulls, those bulls will re-enter and try to continue the bull trend when they find that the bulls cannot effectively break out of the previous high before changing their view of the market state. As in this case, after a high tide reversal, the price doesn't just go down, but it takes on a new sort of convergent pattern, and that pattern breaks down, and that's a sign that the bulls are getting weaker, that the bulls are no longer on the defensive and are no longer buying. That's when the trend is completely reversed. The same is true of the Bitcoin case, where it breaks a channel line and then the rally accelerates. Successive bullish trends, K lines, get longer and longer, and these are all signs of high tide sentiment, and then the price reverses sharply and falls sharply, and when it falls to a price level where the bulls are willing to re-enter the market, the price, he tests the pre-test high again, and he makes a new consolidation interval, which is also a convergence pattern, and when this new pattern breaks down, the whole trend reverses completely. So this high tide reversal, it's also tested twice, but sometimes it's tested so small that it can be ignored, and in this case it's a high tide reversal from the Bitcoin panic sell-off on March 22nd, and there's no subsequent testing of this bottom of 3,000. Or the down band of the two red arrows is a test of the bottom, but it's so small that it's negligible, or the green arrow is a test of the bottom, but it's a mini double bottom and a low rise, which is obvious on the small period and not so obvious on our time chart. Now, as an aside, let's look at the two red arrow drops that we said were a test of the bottom. In other words, we interpret the two drops as a continuation of the previous bearish trend energy. But we can also look at these two dips and see them as a retracement of this high tide reversal that led to a bullish uptrend, a retracement of the previous sharp uptrend, and there's nothing wrong with that. In the real world of trading, we have a lot of these kinds of movements that we have to understand and accept. A high tide reversal in a trend pullback, its band point is not easy to test. For example, in this case where there is a clear bull trend in front of it and then a pullback, and in a pullback this down channel line is broken, and then there is also a short trend K line getting longer and longer and longer. This is a short rally. When the rally develops, most of the homeopathy traders who believe that the pullback is over and that the trend has begun to recover will actively participate in the market because there is no hesitation or uncertainty in their view of the market, so for them it doesn't take a second test to prove their point. Sometimes a high tide reversal can occur at some support resistance level, such as a horizontal bitmap, in this case a band horizontal resistance level, which makes a high tide uptrend line an uptrend channel acceleration and then a high tide reversal. Or he's done a high-speed reversal of this trend line, like here's an uptrend and here's a down correction that's also done a high tide reversal. This pullback is a downtrend on the mini cycle, and this down we see it actually accelerating suddenly here, that this K line with a long line that also has a sharp fall followed by a sharp rise, so it's a high tide reversal or a high tide reversal of the high tide movement at the trend channel, in this case, the channel line, including some other moving averages, and all kinds of support resistance is the same. Some of the more experienced traders, some of the leading institutions will make reversals based on these signals, but I don't recommend novice traders to try it. Because it's very difficult to grasp the logic of how we learn this pattern and the price movement as a basis for taking a profit or closing a lot of positions. At the very least, it can help us warn of risk so that we don't have to be like the novice trader who sees a continuous super positive or super negative line and can't help chasing it. A little bit more about the end flag, the reverse pattern. The end flag is defined as the adjustment pattern that leads to the last push of the trend, and Albrox called all finishing patterns flags and not necessarily channels. So if we look at a couple of cases where the red arrows are the trend consolidation patterns and the green arrows are the trend direction movements, and you can see that these tweaks all lead to very weak trend bands, and they lead to false breaks, and they don't even test the previous trend extremes one by one. Look at them. In this first case it did a flag adjustment, a big drop in front of the adjustment followed by a small drop in front of the adjustment which was weak, and then a terminal flag reversal, which was not followed by a trend reversal, but it did a lateral interval. We talk about reversal patterns, which only very rarely lead to a true trend reversal. Most of them are a large contrarian band or a lateral band. Look at the second case, which is also a strong down movement which makes a simple pullback and then extends the down movement, but the continuation of this move is also weak. He makes a small break to the previous low and then comes back. If you look at this case, it's also a down band, and it does something like a convergence pattern. It's a complex adjustment pattern, and it's the same as this adjustment pattern where the downtrend continues after the break, and the extreme value of the break is the low of the former band, and then the break failure price comes back, and it's probably followed by a reverse trend. And then you look at this case, and it's the same thing, the uptrend pullback, and then it continues the uptrend, but the uptrend is a little bit weaker, and it's not even above the previous high, so it's also a terminal period here, because our definition is that everything that's driven by the last leg of the leading trend we're going to end up with a flag. Some of you may have noticed that by this definition all reversals should have an end and a new type is right. That's right, after all trends have a pullback, and the last pullback is called an end flag, and you can look for any trend reversals you can look for yourself. You see a couple of cases, and maybe some of you can see that that's what's called an end flag. Isn't it just a false break in the trend of low energy? It's true that the definition of an end flag is so broad that we can't trade a lot of patterns. Like in this case it's an end flag, but it doesn't give us a good entry logic, and it's easier if we do the main trend reversal. So let's focus on the false break, so it's easier to trade, since it's a false break in the direction of the trend and the principle of the end flag, and I believe I don't need to say much more about it, and most of you who have watched my videos along the way know that all false breakouts are breakouts with no follow-through, and since it's a trend retracement it should be more conducive to a trend breakout, because there are a lot of players in a healthy trend and they come in at the breakout. When a trend breakout fails, it means that these participants are not coming back in. They are not coming back in the breakout, and they may choose to liquidate their positions. Then the trend energy is weakened and they may face a deep pullback or a trading range or even a trend reversal. We often talk about a toppling reversal pattern, and they're all standard end flag reversals. I'm going to show you a couple of examples of end flags that are easy to trade. So these are standard false breaks, so it's pretty clear to trade, and I'm not going to go into the details of the exit and entry, because the two things that I'm going to share in this video are very hard to master, and this one in particular, end flags, that I don't really use in my actual trading, so it's not recommended for beginners to start trading. We talked a little bit about the entry of a fake break, and in the previous videos you could do it as a fake break and it would be a lot easier. So what is the main purpose of understanding the end period? And I think it's more important to accept the multi-solution of the price movement. So let's take this case where there was a clear strong trend and now he's done a range adjustment, and this is a pretty standard range, and now the range is broken and a lot of people are going to go long. Right, there's nothing wrong with the logic that they're looking for a continuation of the previous bull trend and a nice uptrend, but then immediately after the break, there's a false breakout and the price is back in the range. If you don't know the end ride, the novice trader who does a lot of things, it's hard because the previous trend was so strong and so healthy and the current correction pattern is so good. So why hasn't it gone up since it broke? The inability to understand the price movement can lead to a loss of emotional control, can lead to problems with executive decisions, and the worst that can happen is a big loss or even a blowout. But if we know that there is an end ride, and we know that there is a high tide reversal, and we know that we can change our view of the market when the trend goes wrong, and we can get out of the market, or you can at least stay tuned. And you can manage your orders well. So that's the end of this reversal pattern, and we'll combine these videos. So if you think back to the first video where I talked about reversing the K line, one thing I mentioned is that all price reversals are upsurge movement with a contrarian break, and you put that together, and I think you'll get a little bit more insight into the market movement, and the next video will summarize all of these patterns that we've learned help you improve your ability to read pictures. So today's content have come to an end. Thank you for watching. Please consider like, comment, and subscribe. Also don't forget to follow us so you watch the following updates as fast as the video upload. Bye.